Okay, back to hopefully what'll be the last installment on partnerships. Just wanted to go over the profit and loss sharing agreements. Remember, partnerships come in three varieties, or at least they come in three sections. I bet is the better way to describe it. There's an equity section, so partners will agree that they're going to share in the equity of the partnerships by certain percentages, and again, they can change that at any time. And that equity means basically, for purposes of understanding it, the amount of dissolution value upon the dissolution of the partnership, how much each partner would get. That's what equity basically means, amounts received upon dissolution. Profits sharing arrangements, again, refer to just that, how much profits each partner will take. And the same thing with the losses, how much the loss would be that each partner would take. And the agreement can be fixed, it can be changeable, it can be as flexible as the partners need it to be. And that's one of the beauties of the partnership arrangement. Okay, having said that, let's see what some profit sharing agreements look like. And as we said in the last segment, it's a good idea to have a pretty strong partnership agreement ahead of time so everybody understands what's going to happen. Common ways that partnership agreements work is that there's a percentage based of remaining profits. There's an understanding of what bonuses may be paid out. There's an understanding of what's called a salary allowance. And sometimes a understanding on how much interest will be granted to a partner who brings in a certain amount of value, real value, not talking about intangible value, talking about real value of dollars or property. Oftentimes partners are given a interest based on the value they bring in. That's what's called a preferential rate of return, meaning that they receive a preferential interest factor rate for the value that they bring in. Preferential will mean the fact that it comes before the profit sharing arrangement itself. That's what the preferred concept means when you receive an interest allowance on the capital that you bring to a partnership. This slide is not law, it is not required, it is but an illustration of typically the way partnership agreements work. Salary allowance is termed on here because there is no such thing as a salary for tax purposes in the United States of a partnership. So they call it a salary allowance because it mimics a salary where you agree to pay a partner a certain amount for his contribution during the year, and the contribution is similar to what a person would earn for a salary. So you're agreeing to do that with a particular partner or partners, however the case may be, and it's called a salary allowance. The real jargon for tax purposes and what you'll hear in the real world most often, instead of a salary allowance, is you'll hear what's called guaranteed payment. That's the term of art for this salary allowance, guaranteed payment. And it means that it's guaranteed regardless of profits. We're going to pay you for your contributions to the service of the partnership during the course of the year, regardless of their profits. So it's guaranteed payment. It's not guaranteed in the sense that you're absolutely going to get it. The partnership doesn't have the money, it's not going to pay you as a partner. But it's guaranteed to be paid as long as there's cash available, even if there aren't profits. And sometimes partnership agreements have what they call a cash flow allocation. That's another way of partnership agreements saying that we'll divide up profits. That's one way. The other way is just say upon available cash, we'll split the cash in these ways. So this is describing bonuses are sometimes based on profits, sometimes just based on performance. Partners sometimes sit down at the end of the year and say, well, partner A did a great job, we're going to give him a bonus based on that job. He met his goals. The partner B may not get a bonus, just get the salary allowance or a guaranteed payment that was agreed upon at the beginning of the year or at some time. And even though it describes salary allowances here as not expenses in the determination of partnership net income, that's that is purely discretionary in the hands of each partnership agreement. Guaranteed payments are oftentimes considered deductions in the determination of partnership net income, and that's more typical than what this slide says. This is the preferential return on investments that partners make, generally based on the measure of the partner's capital. Because after all, if we're measuring the partner's capital based on the fair market value, then it makes it easy to use the preferential rate of return for the investment based on the capital account, because the capital account will reflect fair market value of the investment given to the partnership. The preferential calculation here is just one illustration of the way to do it. Allocating income, partners' allowances for bonus, salary and interest are allocated to them, even if profits don't exist, and then if there are profits, those are split according to the agreed upon proportions. And as the slide in this case correctly reflects the real world, these are just general procedures. Each partnership could have its own way of allocating income. So this is more or less just for illustration purposes. This is not written in stone that it must be this way. Let's take an example. Here we have two partners, and they are given these salary allowances or guaranteed payments of $60 and $30 respectively. There's a bonus arrangement to partner Babel, 50% of profits in excess of $500. That's just an agreement of what his bonus will be. They have investments into the partnership, and there's a preferential rate of return of 10% based on the beginning capital. And then the remaining partnership's profits or losses are shared in their initial 60-40 agreement. Well, we think it's initial. It could have been, it doesn't have to be the initial, but that's just how they've agreed to do it. And partnership profits are $660 for the year. So let's see what happens if the profits were $660. So here's the net income of the partnership, $660. Subtract the salary allowance, subtract the bonus, subtract the preferred rate of return. Get a subtotal. That subtotal is split. And here you see the slides contradicting what it said earlier, where the salary allowance is recorded as a deduction for purposes of getting to the net income, which is, again, the typical way this is done. You'll notice that even though there's a 60-40 split, at the end of the day, because of the salary allowance and the preferred rate of return on the capital account, which is the interest allowance, the allocated net income, bottom line, is not necessarily 60-40. In fact, it's not. It's definitely not 60-40 because of the other items in the agreement of how monies are going to be split. Cash flow is going to be split before splitting the actual profits left over. You could have a partnership with no salary, no bonus, no interest allowance, and just split the profits according to a profit-sharing arrangement. You could have any combination of these concepts. Now let's get another example. This time, unfortunately, the partnership didn't do so well. And it's saying assume the income was only $180. Actually, I think the illustration shows it at $120. And the result is, as you can see, that the salary allowance still is paid first and is a reduction. The preferential rate of return is a reduction. And the result is that there's a loss. And that loss is allocated 60-40 because that's the agreed upon loss sharing arrangement. And thus, the actual distributions or the net income allocated to each partner doesn't exactly correspond to the desired 60-40 because it's a net loss. So the net income at the bottom of the screen, which you can't read too well there, will not necessarily be 60-40 after the loss sharing arrangement. So what happens in a situation like this typically, you might say, is it doesn't look like there's enough cash to pay out the salary allowance or the interest allowance. And in some cases, there is cash flow allowing for it, even though the net income is lower because of depreciation. But skipping that, which is for more advanced taxation partnership accounting rules, let's assume the net income was the cash available. So in this case, what will happen is the bonus would be paid, and what I'm giving you is the typical agreement. The bonus would be paid to the various partners. The interest allowance would not be paid in full because there wouldn't have been enough cash, and there'll be a carryover of money owed on the interest allowance. So the preferred rate of return on the interest on the capital accounts, that would be deferred, carried over, and paid out when cash was available. So the net result in that case is that the interest allowance would net the partnership to a zero profit, a zero loss, and that would be the end of it. So we would pay out the interest allowance. In this case, would be $30. Split it between the two partners according to their partnership capital accounts, relatively speaking, and then we would just keep a schedule showing how much was still owed for their profit sharing arrangement. Okay, that's about, I think that's about it, because the rest of the slide, admitting new partners, will follow the goodwill bonus method, similar to what we showed for bringing in new partners, and so I think that goes beyond what we need to accomplish, certainly for purposes of preparing you for the CPA exam and the final on this coming Monday. So we thank you for participating, and if you have any questions, give me a holler and we'll go over those, and I may send out some additional information if necessary.